Hello, I'm David Frazier, the president of Frazier Mayor Research LLC, which is the provider of Investors Monitor, investorsmonitor.com, and our individual investor service, Frazier's Strategic Allocator. We're recording this week's Market Insights show on Tuesday, November 22nd. As I think you know, we generally record these shows on Saturday or Sunday of every week, but this past week I decided I really wanted to do a little more extensive research into certain factors regarding the U.S. economy primarily, but also recent economic developments from around the globe. And I also wanted to review some inflationary statistics and interest rates, or I should say recent movements up in interest rates. Lastly, I've decided that because the next edition of our monthly investment journal is due for issuance next Monday, that I thought, therefore, I will not be recording a weekly video this coming weekend, nor will I be writing a weekly commentary, since only this coming Monday our monthly investment journal is due. So I wanted to record a longer video. And not just I wanted to record a longer video. I guess the way to put it is that I wanted to make sure I covered a lot of important information in this week's video. So first of all, I wish all of you a very happy Thanksgiving week and a happy Thanksgiving Day. Thanksgiving for myself is a very, very important day, extremely important day. It's a day that I always spend time with my family, have done since, and I recall doing so since the age of 5. It's just a very, very important day for me, and I hope all of you enjoy your Thanksgiving and hope that you're able to get together with family members. Having said that, in this week's video, I'm going to talk about some recent developments in the U.S. stock market and where I think stocks are headed from here, and some factors that I expect to impact or not impact stock prices during the months ahead and over the next couple of years. So first of all, let me take a break right here for just a moment, and I'm going to first go to some screens that will show the performance of stock prices in general, the major market indices is what I'm speaking of. And after I go over a few charts regarding developments that occurred over the past couple weeks in the U.S. stock market, then we're going to review some charts on inflation statistics, interest rates, oil prices, and the U.S. dollar. So I'm going to pause here for a moment, and then we'll go to our internet website. Okay, first of all, I ended just a moment ago by saying that I was going to go to our internet website, and please forgive me, I'm actually going to start with reviewing some charts of the recent performance in the U.S. stock market. And at the moment, what you're seeing here on our screen is a chart of the S&P 500 index. And we're going to take this drawing tool that I have, this pointer is what it really is, and we go back to November 4th, which was the recent low in the U.S. major stock market indices. That's true for the S&P 500 index. It's true for the Dow Jones Industrial Average, and it's true for the NASDAQ Composite Index. And obviously, we've had a fairly substantial move up in the prices of all those indices since November 4th, and a sharp move up since since election day, right here, November 8th. I'm sure all of you are well aware of this. All of the indices have moved higher since election day. But something that I want to say right here, I'm just going to stop and pause for a moment, it's something that I said in last week's video, and I think possibly in the video prior to that, in our Market Insights show, is that I'm very, very against chasing after stocks. I try to never chase after stocks. I don't want to get emotional and buy near highs. That's really a bad thing to do. I mean, there's always pullbacks in stocks within a few weeks after stocks rally sharply. That always happens. So we don't want to chase after stocks and get in near highs and increase our risk. We want to be patient. We don't want to get emotional. And we want to monitor certain statistics that historically have given good clues as to good entry points. And for example, now we're going to go back and look at the S&P 500 again. Well, yes, we've had a good move higher, but it's not like we've had a major move. I mean, since the recent lows back here on November 4th, the S&P 500 index is up only 4.6%. That's all. And since election day, since November 8th, I could move this back to the 8th here. Since November 8th, the S&P 500 index is up only 2%. That's all. Only 2%. Those are not major moves in the market indices. And look what has happened here since election day. Well, here this is November 9th, the day after the election, this pointer. What I really want to focus on is down in this area. Here's the trading volume. And the trading volume moves substantially higher. Whoops, let me go back here. There's November 8th, the day after the election on November 9th for the S&P 500 index. For the Dow Jones Industrials, I have to move this out of the way so you can see it. This is November 9th. So you'll see, whoops, that's November 9th. Okay, right here, when the trading volume increased substantially for the Dow, for the S&P 500 index, and for the NASDAQ Composite Index. NASDAQ volume moved substantially higher on the day after the election. But let's go back to the S&P 500 index. Now, we all know that major U.S. stock market indices have continued to move higher over the past week and a half. But look at the trading volume. The trading volume's been declining almost every day since, well, not since the election, but since 2 days after the election on November 10th. Trading volume has been declining, trending lower for the S&P 500 index. That's also true for the Dow Industrials. Here it's been relatively constant, but it's definitely been substantially lower than since the day after and 2 days after the election. Moving lower, trending lower. It's also true for the NASDAQ Composite Index. And those of you that have been active in the stock market for many years are well aware that you don't want to be buying, you don't want to be going into stocks aggressively when they're moving up on lighter and lighter trading volume. You want to wait for the indices or any given stock to then pull back on light trading volume. And why is that? Well, once again, those of you who have been active in the markets for many years know that lower and lower trading volume is telling us that fewer and fewer people are getting into stocks. You want to wait for that pullback on light trading volume. Why light trading volume? You want to see selling, but only by a smaller number of or percentage of financial market participants. And that's because when fewer people are going into stocks when the movement's up, that means they don't expect the move to continue upward during the days and weeks ahead. They don't want to get in near the highs. And if you see light trading volume on when stocks decline, that means that few people are getting out. So this is not the time to be going into stocks. Secondly, even though I'm going to move this out of the way, well, let's just get this out of the way. Move up to here. I guess it doesn't really matter. Let me get rid of that for a moment, the pointer. Secondly, in last week's video, I mentioned some price momentum statistics, and then after I recorded the video, I noticed, boy, I was covering up what I was trying to show you with my image down in the during the right bottom corner of the charts that I was showing you, and I don't know if it had much value. Well, today in this video, I'm not including an image of me in the video down here. So now what I want to take a look at is, let's go back to the S&P 500 index. And this here is a price momentum statistic. And as I mentioned in last week's video, but you probably weren't able to see it, put this pointer back on. Historically, whenever this price momentum indicator gets up to very high levels, over 85 generally, you'll see stock prices in general, the major stock market indices, it's true for individual stocks as well as for the major indices, you'll see stocks pull back. So that's true here. Back here during June of 2016. Let's go to the Dow. It's true for the Dow when this was at a very high level. For the NASDAQ. It's true for the NASDAQ when this got to a very high level. I mean, we could go through every data point here. We're not going to. But let's just come over here. And what we see now is this price momentum statistic is at the highest level possible as of the market closes on Monday. Actually, this is as of this morning on Tuesday, November 22nd. At the highest level possible, 100 for the S&P 500 index. For the Dow, once again, this price momentum statistic is at the highest level possible at 100. I don't know if it's true for the, it's also true for the NASDAQ Composite Index, the highest level possible. So this is a very reliable short-term overbought, oversold indicator. And when it gets up to 100, you do not want to be, that is the worst time to be going into stocks. You want to see for the price momentum decline substantially. And for example, here when it gets down to a real, well, it's not true there. It's not going to always be perfect. But here it's still at a very low level, this price momentum statistic. Let's go back for the S&P 500 index. And what do you have? Then stocks rebound. Let's go to the Dow. It gets to a low level, stocks rebound. For the NASDAQ, gets to a low level, stocks rebound. And we could go back. Let's just take, well, no, I'm not going to bother to do that. You could, but generally speaking, once again, we don't want to be buying when this is at a very high level. We want to be buying when it gets to a low level. And sure enough, come over here to November 4th, the recent lows, and you'll see this price momentum statistics was near zero. It's near its lowest level. Stocks rallied. That's true for the NASDAQ Composite Index. True for the S&P 500 Index, very low level. True, I'm sure, for the Dow. Yeah. So we don't want to be buying now. This is not the right time to be entering the market. Now let's take a look at these infrastructure building stocks that I wrote about in the Trump versus Clinton special report for those of you that watched our Trump-Clinton webinar. We provided that to you. If you did not get that report, please let me know. Just send us an email, and I'll be sure to send you a copy of that report. But the stocks that I covered in that report, in the event that Trump were elected, that I told you my research indicated would perform very well, included several infrastructure stocks. I'm sorry to keep going up and down here. I'm speaking, not paying attention. But let me try to find those stocks. Why can't I find them? Looking for infrastructure stocks. When you know. Why can't I find these? Just a moment, please. Well, this might be frustrating. There's the market indices. My apologies. Please bear with me. Well, this is going to be frustrating if I can't find these. I know they're here, but I just don't see them. Well, I'm not going to spend much more time on looking for these. I know what some of them are. I'm going to look just a moment more. I don't know why I can't find these cyclical stocks. Growth. Well, I know they're here. I don't know why I can't find them, quite honestly. Very frustrating. We'll just put in some symbols. That's what we'll do. We'll just jump around here since I can't find those and don't know why I can't find them. So, for example, GVA, Granite Construction. You know, it's moved up substantially since the election. Here's November 9th. Made a substantial move higher. But look at the trading volume. It's been declining. Look at this price momentum statistics. Up here near 100. We do not want to be going in here. Another one is Quanta Services. Moved up sharply on the Trump. I don't even need that. Let's get this out of the way. Because I know. Moved up sharply right here the day after the election. But trading volume has been declining. The price momentum statistics is near 100. We don't want to be going in here. Let's see. We'll look. Even this is one that I didn't. Cliffs Natural Resources is another one that I'd written about. Here's the day after the election. Jumped up substantially in price, but trading volume has been declining. Price momentum statistics are at a high. And lastly, one more that I did not write about in that special report, but Caterpillar also moved up substantially the day after the election, but since then the volume of trading has been declining and price momentum statistics are right up near 100. This is not where we want to be entering these stocks. We want to be patient. We want to see a pullback to some, maybe, for example, right here in this level, to a support level for Caterpillar if we were to go into that. We'll take a look at Granite Construction one more time, and we would probably want to wait for a pullback to, at least down to this level, and maybe, excuse me, maybe we would even, watch it closely and wait for it to pull back to this level, but I'm not sure it's going to get that low. We want to be patient, so we're not going to go in these stocks here. So, I hope you're keeping up with me here and that I'm making sense. So I think that's enough about what's occurred in the U.S. stock market and some infrastructure building stocks that I mentioned previously. So now we're going to, I'm going to take you to our website, and we're going to look at some charts on inflation and interest rates. Very, very important. So let me minimize that, and let's go to our website. And by the way, we're probably about 15 minutes into this video already. I'm expecting it to last for approximately another 15 minutes, total length approximately 30 minutes. I hope that's not too long. What I'm covering here, I think, in my opinion, is very, very important. So, not all of you are familiar with what I'm discussing. I want to make sure I'm keeping you abreast of the reasons that we're not yet going heavily into stocks, and I'm not advising you, our subscribers, to do so, and why we want to be patient. And really, I think I just covered that in just a moment ago and looking at the trading action in the U.S. stock market. But now I want to talk about some other factors going forward in the year ahead. And what I'm going to talk about first is inflation and interest rates. There's been a lot of talk about interest rates. Well, the Fed's going to raise interest rates, and the media is just obsessed with interest rates. Been talking about this for almost 2 years now, thinking interest rates were going to be raised by the Fed. That is short-term rates, the overnight born rate, the Fed funds rate. And I told investors repeatedly over that 2-year period that was not going to happen, because we'll continue to see sluggish growth in the economy. And sure enough, we only had one Fed rate hike over the past 2 years, and it was extremely modest, from a target of around 0% to a target around 0.5%, 0.25 to 0.25%. Very, very modest. But, okay, enough about that. This is not to pat myself on the back. It's just, I bring this up because it never ceases to amaze me how often the media is wrong, how often these Federal Reserve presidents, who you would expect to be knowledgeable persons, have been wrong, and how often many so-called experts have been wrong. It never ceases to amaze me. It just, I don't know what these guys do. I guess they spend too much time on the golf course. So, first, now we're at our internet website, Investors Monitor, investorsmonitor.com, and I'm going to, where I'm going to take you to, which you can do on your own at any point in time, is I'm going to take you to this Econ Monitor, Economic Monitor, and I'm going to click on this Economic and Fundamental Stock Market Indicators, which you can do at any time at your leisure if you want to take a look at any of our charts on Economic and Fundamental Stock Market Indicators. And when that loads, give it a moment, I'm going to scroll down to some inflation statistics. It doesn't. And the first thing we're going to take a look at is the Consumer Price Index. And I'll tell you why once that chart loads. I'm on a wireless connection here on this particular computer, so it loads a little bit slower. I guess I could have hooked it up to a landline, but so much for that. Okay, so what's going on with this Consumer Price Index? Well, it's quite now. All we got to do is look at the chart. And all of my charts, I've told you this in the past, the blue line is going to always be the indicator, and the black line is going to at least usually be the S&P 500 index. We want to relate these indicators to stock prices. We want to know how stocks in general, as measured by the S&P 500 index, tend to respond to readings on these economic statistics. And not surprisingly, we'll see here that when the Consumer Price Index got to an extremely low level and bottomed and then turned higher, well, what happened? The S&P 500 index moved higher. And that doesn't surprise me in the least. And I mean, it never ceased to amaze me. Back in mid to late 2008, there were many people who had claimed that we were going to have rapid inflation. The dollar was going to collapse. The dollar was going to no longer be the world's currency. That this rapid inflation was going to cause big problems. And it's just pitiful. These guys, I just laughed at these guys, how ignorant they apparently were, or they were purposely misleading people. I don't know. But, we did have some inflation. Well, of course we had inflation, because asset prices had been depressed substantially during the economic downturn of 2008 and the first half of 2009. And when we started having the economy start to improve, of course, asset prices are going to move higher. But during the early stages of inflation, that's not a bad thing. We want prices to move higher. We want, because how is the price of any good service determined? It's determined by quantity supply versus quantity demand. And if demand increases relative to supply, well, of course, prices increase. Demand increases generally when the overall economy is improving. I don't want to get into a dissertation here. I'm sure most of you are well aware of that. So I bring this up because we see that this Consumer Price Index has been trending higher over approximately the past year. And not surprisingly, U.S. stock prices, as measured by the S&P 500 index, moved higher during that period. Now, we didn't have a big move higher. I mean, most of this period right here, since around May of 2008, 15 when I told our subscribers and clients to get primarily out of stocks because I saw some big warning signs. Stocks moved mostly sideways since then, and only recently did they break out of this sideways pattern and move higher. This chart is through the end of October. So we've had some movement up in the consumer price index, and we're probably going to see the consumer price index continue to move higher during the year ahead. And why is that? Because in my opinion, based on my research, the U.S. economy is going to improve substantially. But historically, you always all have these people to act like that's a bad thing. It's not a bad thing. It only becomes a bad thing when you get these inflation statistics at high levels. And historically, I'm only showing a chart back to 1996, but I know back 50 years that I've looked at this data, and actually even further back than that, I've gone back to the 1930s even, that generally speaking, the only time that you see stocks peak and move substantially lower is when this consumer price index tends to get up to around 3.5%. I mean, it was true here back during the early 2000s. It was true here during late 2007, and we're nowhere near that level. I mean, we're only right around 2% as of the latest month. So inflation is not going to be a problem. That's just one inflation statistic, the consumer price index. Let's click back. We'll go take a look at a few of these inflation statistics. There's the consumer price index. You're going to see that the same is true for now the personal consumption's expenditures price index. It's just another broad inflation statistic. And we'll see that once this loads, oh boy, I guess I'm going to have to hardwire this next time because this wireless connection moves too slow for me. Well, once again, what happens when this personal consumption expenditures price index, the PCE index, what happens when it bottoms and moves higher? The S&P 500 moves higher, only till it gets up here to around this one to around 3%. Do we see the S&P 500 index move lower? But then when it bottoms again, it moves higher and it gets out down here to a low level. But then we have some inflation. What happens? The S&P 500 index moves higher, and the S&P 500 index and stock prices in general do not peak until we get up to around 3.5%. So we've had this inflation statistic moving higher for about a year now. Not about 9 months actually. Of course, we're seeing improvements in the economy, but we're less than 1.5%. This is not a problematic level. It's a good thing. Inflation's not, the early stages of inflation is not a bad thing. It's a good thing. You want to see prices move higher. You want to, in other words, you want to see the demand versus supply of goods and services move higher. It indicates that the economy is improving. I mean, it's true for also the GDP price deflator. That's going to take a moment to load. I really do want to take a look at all these charts, so I hope you continue listening here. We're going to get into interest rates here in a moment, and oil price and the U.S. dollar index. So it's true for the GDP price deflator. Moving higher, that's a good thing. It's nowhere near this 3 to 3.5% level. So inflation's not going to be a problem. This is actually a positive development. And now what we're going to take a look at, all of these three inflation statistics that I've mentioned relate more so to demand pull inflation versus cost push inflation. And I'm sure some of you are familiar with that, but I'm sure some of you are not. Don't worry, I'm not going to get too academic on you. Well, demand pull inflation is inflation that results from the demand for goods and services rising at a faster pace than increases in supply. Demand is increasing relative supply, and that's because individuals and businesses are feeling better about the economy, where the economy's headed. That's a very, very positive thing. But now we're going to take a look at some cost push inflation statistics. In other words, when the cost of basic materials, for example, whether it's the components that are used to produce goods, the materials prices, the cost of those goods. Well, look at this: the producer price index, what the components that manufacturers need to produce the goods that they make. Well, look at this. This is, it's there is no cost push inflation. Materials prices are not rising. In fact, they're still declining. We're more than 5% during the month ending in October. So, there's no cost push inflation. I'll tell you why this is important in just a moment if you don't already realize it. It's important because if the cost of materials that producers of goods need to buy to make their goods rises substantially, well, that can be an inflationary problem because it might not have anything to do with supply and demand. It still indirectly has to do with supply and demand, but it's not at the retail level where individuals are going to face huge increases in the prices of goods because the materials to produce those goods rise sharply. That's not what we're seeing. It's just the opposite. The prices of those basic materials are not rising. They're still falling, actually. So the only reason that we're seeing some increases in general inflation, the consumer price index, the personal consumption's expenditures price index, is because the demand for goods and services is rising, because people are feeling better about the economy. And we're going to look at one more producer price index, and that's for once these are really finished goods, goods that are ready to be placed on the shelves of retailers. And look at that. That still moved lower in the latest month. There is no cost pressure here to produce goods. So that's a very, very positive thing. So I'm saying all this, hopefully this isn't too academic. It's very, very important because you're going to hear people start talking now about inflation. Oh, inflation's moving higher. Oh, of course it is, because people are feeling good about the economy. That is not a bad thing. That's a good thing until we get up until we reach very high inflationary levels. And so now I've been discussing these inflation statistics because now I assure you, you're going to hear the media on these broadcast financial shows. You can hear all these so-called experts talk about how the Fed's going to raise interest rates. Now, interest rates are going to be a problem. Well, they're not going to be a problem. And so we're going to take a look. First, we're going to look at the yield on the 10-year Treasury note. And probably a lot of you are well aware of, for no other reason, because the media is so obsessed with this, is since the election on November 8th, this year right here is November 9th. This is the yield on the 10-year Treasury. This is as of last Friday, November 18th. And right here where I'm pointing the mouse is as of November 8th. Well, look what's happened to the yield on the 10-year Treasury since Donald Trump was elected. It moved substantially higher. And why is that the case? Because financial market participants, people who participate in the bond market, they think the economy is going to improve substantially. And they're right. It is going to improve substantially under Trump. I've been telling you that. There's no doubt in my mind. And therefore, they expect interest rates in general to move higher under Trump. Of course they're going to move higher. Some of you are probably thinking, if you listen to the general media, boy, that's going to be a bad thing. That's going to hurt stocks. It's not going to hurt stocks. It's not, and I'm going to get to that in a moment. So we've had, over the past week and a half, the yield on the 10-year Treasury moved substantially higher. But has it risen to any problematic level? And the answer is no. Now let's go down to a chart below here, a longer-term view of the yield on the 10-year Treasury and how stocks tend to perform. Well, we go back here to the late 1990s, and the yield on the 10-year Treasury started rising. But stock prices kept moving higher. Wasn't a problem until we got up here to close to about 6.8% on the 10-year Treasury. Did stocks then move substantially lower? I mean, and then here, when the 10-year Treasury bottom and moved higher, stocks had already started to move higher during late 2002, but they continued to move higher, even though the yield on the 10-year Treasury was moving higher, until it got up to around 5%. And then stocks collapsed during 2008. But then, or even before, of course, let's not even look at this, but you'll see here again, during 2012, the 10-year Treasury yield moved higher. The S&P 500 index continued to move higher. So here, yeah, the yield on the 10-year Treasury moved higher during October and substantially higher over the past week and a half, but we're nowhere near any problematic levels. It's still, even recently, we're only slightly over we're about 2.7%. About 2.7% here. Well, that's not a problematic level. It's going to have to get up to at least 5% historically for that to be a problem. Let's now go back. So that's the yield on the 10-year Treasury note. Yes, interest rates are probably going to continue to move higher, but to not any problematic levels, in my opinion, to constrain economic growth or to hurt stock prices. Let's see. Let's take a look now at the 30-year conventional mortgage rate. Well, also, since Trump was elected, mortgage rates in general, and I'm using the conventional 30-year mortgage. Here's the day of Trump's election. This was November 8th, and this is as of last Friday, November 18th. Mortgage rates moved substantially higher. Of course it has. Once again, financial market participants, bond market participants, expect the economy to improve. Of course interest rates are going to move higher. But one more time, taking a longer term look at the 30-year mortgage, going back to 1996, and I could have gone back way beyond that. But here, mortgage rates moved higher in the late 1990s. Stocks continue to move higher. Not till it got to a high level. Did the S&P 500 index fall sharply? So, here it moved higher. Stocks moved higher. This was during 2012 and 13 again. So, this is not a problem. So now, one more chart of interest rates, and then we're going to move on to oil prices and the dollar. And hopefully I'm being clear why all of this is important. And why I monitor these statistics as well as about 150 other economic statistics from around the globe on a regular basis. So now let's look at the interest rate that the media is so obsessed with, and that is the Fed funds rate. And we're actually looking at the effective Fed funds rate as opposed to the target rate. The target rate is what the Federal Reserve is targeting in its buying and selling of U.S. government securities. The effective fund rates, the overnight borrowing rate that banks lend to each other, is the actual rate. And so let's look historically. I think I might have mentioned this chart to some of you in the past, but I'm sure a lot of you have never seen it before. And let's take a look what's happened historically when the Fed has started to raise the target Fed funds rate. Let's go back here to the 1950s. That's right, way back to the 50s. And we'll see, 1954 to around 1958, the Fed funds rate, this is the blue line, was moving substantially higher. The black line's S&P 500 index. What happened? The S&P 500 index moved higher. It didn't hurt stocks. Same true here during around 1959 to around 1960. Fed's funds rate moving substantially higher. But look, S&P 500 index moved higher. I mean, it's true throughout here. You can go over this chart on your own and look closely at it. I mean, here again, in the late 1980s, Fed funds rate moving substantially higher. S&P 500 index moving higher. Happened again during 2004 to 2008. Fed funds rate moving higher. S&P 500 index moving higher. So I bring this up for the reason that should be quite clear, and that is stocks often rise during early rounds of Federal Reserve rate hikes. So, of course, the Fed's going to rate hikes, in my opinion, at its next meeting on December 13th to 14th. I'm sure it's probably going to happen because we've had actually the readings, the most recent readings on some economic indicators indicate that finally are indicating that the economy is probably bottomed. It's going to grow at a faster rate during the months ahead. And in my opinion, it's going to grow at a much faster rate during the year 2017. The Fed's well aware of this and looks at all the data that I look at. I'm not sure it looks at more data than I do. Might even look at less data, but it looks at a lot of the same data. It's seen the inflation rate move up a bit. It's seen the economy improve. And yeah, they're gonna raise rates. But if you listen to these so-called experts on these broadcast financial shows, they're going to convince you that, oh, you probably need to get out of stocks. That's going to be a bad thing. That rally that we've had in stocks is short-lived. So what I want to see happen, this could be the trigger to see a sell-off, a short-term temporary sell-off that I want to see so that we can go in and buy at some good entry points in these infrastructure stocks as well as numerous growth stocks that I've been monitoring. So I would love to see stock prices in general sell-off if the Fed announces on December 14th, as I expect it to do so, that it's going to raise the target funds rate from 0.50% to 0.75%, and then the media comes in and acts like this is going to be a horrible thing, that all these so-called experts start talking about how this is going to be a bad thing, it's going to choke off, it's going to choke growth, and that now we're going to see a big decline in stocks. I hope we have a healthy pullback. That would be fantastic for us because, historically, early rounds of increases in the Fed's funds rate have not hurt stock prices. And why? Very clearly, because only, once again, until inflation gets out of control and the Fed comes in and raises these rates to high levels, until then do we see big sell-offs in the stock market. And until not only the Fed's funds rate, but long-term interest rates. Let's go back again. I'm going to go back one more time here. So there's the Fed funds rate, the target rate, the rate that the media always talks about. Very, very short-term overnight lender rates. Let's look one more time at the 10-year Treasury note. 10-year Treasury note. To show you one more time that only when inflation starts to get out of control and prices are rising at a rapid rate and interest rates therefore get to high levels, only after rates get to those high levels on the 10-year Treasury, generally around 5% or higher, do we see, really here it was up in close to 7%, but here around 5%, do we see stocks sell off sharply? We're nowhere near that. So, hey, that'd be fantastic. I'd love for the Fed to come in to raise the short-term borrowing rate, for the media to talk about it, for all these so-called experts to talk it out, how now stocks are going to pull back sharply. Hopefully they do pull back sharply, or at least considerably for a few days, and we'll go in and buy at some great prices. Okay, boy, we're probably into 30 minutes already. I hope I'm not boring you here. This is very important stuff. So now I'm going to go and take a look. I should have just hit the back button here to speed this up. But I now need to wait since I didn't do that. So our indicators. So now let's take a look at, I was going to look also at commodity prices, CRB spot index, Commodity Research Bureau spot index, West Texas Intermediate crude oil. Maybe we'll take just a one. Gasoline prices. We will look at crude oil prices. And waiting for that to load. Yeah, this wireless connection, I'm going to have to hardwire this next time. This is a little slow for me. Sorry about that. But another, you could call it an inflation statistic. Well, of course, the demand for crude oil goes up like it did back here in the 1990s when the economy was improving, and stock prices moved higher. Only until we got crude oil prices at very high levels did we see stock prices move substantially lower. Well, yeah, crude oil prices have been trending higher for about 9 months now, at least since the beginning of the year. The economy's improving, demand for oil increased. So, of course, crude oil prices moved higher. And that's a big reason that I had recommended in January of this past year for our clients and subscribers to allocate some of their money to some oil and gas partnerships via exchange traded notes, ETNs. But because I expected oil prices to move substantially higher during the first half of the year, and they did. And we made some decent returns off those ETNs. But where are oil prices going to go from here? Are they going to keep moving higher? In my opinion, no, they're not going to move substantially higher, because the economy, even though I expect it to improve substantially during the year ahead, it's going to take some time. It's not going to just turn on a dime and grow at 4 or 5% just right out of the gates. It's going to take some time for these economic policies that Donald Trump is proposing, primarily cuts in tax rates, also less regulation of U.S. businesses. It's going to take some time for those to take effect. So I don't expect crude oil prices to move substantially higher. They're probably going to stay right in this level where they are right now. The same is true for gasoline prices. And I say that also not just because of likely economic developments, but by just taking a look at the supply of oil versus the demand for oil. And so now I'm going to go here and click on this oil demand versus oil supply indicator. And what we're going to see is over the past few months that the supply of oil has risen substantially. Well, not substantially really, but it has risen above the demand for oil. The blue line is the worldwide supply of oil, and the black line, the blue line is the worldwide demand for petroleum products. Not just oil, but other petroleum products. We don't want to just look at crude oil. We want to look at natural gas, gasoline, any type of petroleum products. And the blue line, is the worldwide demand for petroleum products. Been moving higher. But I'm going to make this screen a little larger. I'm not able to do that actually. Well, there we go. Wow, I made it too big. I figured I should have left it where it was. I don't know if this is going to fit. That should fit. Scroll down a bit. And we'll see here. So the blue line is a worldwide demand for petroleum products. The black line is a worldwide supply of petroleum products. Well, supply moved above demand during the past month and a half, actually. So if supply is higher than demand, well, you can bet that oil prices are going to remain in check. Gasoline prices are going to remain in check. They're not going to rise substantially. So that's a very, very positive development. Okay, I've talked a bit here. I'm just going to lower that. I guess you don't need to see that screen. We'll go back to our home page. If nothing else, I think that's probably a good place to wrap things up for this week's video. Lengthy video, probably. I'm sure it's over this 30 minutes that I was expecting. It's more like probably about 40 minutes. I hope you're okay with that, and I hope you learned something, and I hope you understand why some of the reasons that I expect stocks to move substantially higher during the year ahead, and why I'm telling you though to be patient and wait for a pullback before we go in and buy some of these stocks that I mentioned in previous videos, commentaries, in our monthly investment journal. So I thank you for listening, and as I said, this coming weekend we will not be doing a video. I'll be working on our monthly investment journal, which is scheduled for release next Monday. So I'll talk to you again in about a week.